Hello and welcome to the Brodie's Banking and Finance Academy, our regulatory roundup. This session today will be presented by my colleagues Lindsay Lee, Kiva Hunter-Blair and myself, Kimberley Ryder-Forman. So these are the topics that we will be covering in our session today, and I will now hand over to Lindsay to get things started.
Thanks, Kimberley. So first up in the mixed bag for today is the consumer duty, and I've got 10 minutes to cover what we think firms should be doing in preparation for the consumer duty coming in. So this as build is very much bite-sized. But just setting the scene before we look at what firms should be doing, just a little bit on the consumer duty itself. And we can see from the quote that's on screen that the consumer duty is about setting higher standards for firms, about putting consumers at the centre of regulatory strategy. And the aim of it all is to generate good outcomes for consumers. In terms of timeline, we know that the implementation period has been extended slightly, which is good news. A bigger extension would have been better news. But we're now looking at the 31st of July next year for implementation for existing and new products and services, with closed book products and services following a year later in July 2024. So the first deadline for firms is actually really quite imminent. It's at the end of next month, and by then firms' boards should have agreed an implementation plan for the consumer duty. It's really important that firms, in preparing their implementation plans, document all their decisions in relation to consumer duty matters at board level or senior management level, because the FCA has made quite clear that firms should expect that they will have to share, or they might have to share, their implementation plans, their board papers, board minutes, and be challenged on their contents. So the better documented your decisions are, the better position you will be in if the FCA comes knocking at your door. So in order to pull together your implementation plans, firms will be carrying out gap analyses, looking at their existing business practices, processes, communications, etc., against the new requirements. Now, many of those practices and other things are going to be based on TCF principles, but the consumer duty is very much a different animal. It's about outcomes, and it's about demonstrating that your firm is generating good consumer outcomes. Really important in pulling together your consumer duty implementation plan is involving stakeholders from across the firm. Potentially all areas of a business could be impacted by the new requirements. So this is not just a job for your legal and compliance teams if you have them. In terms of products and services, just back a slide, firms need to be working out which products and services are in scope, and those will be those which are with retail customers, and what retail customer is depends across according to sector. And for each scope, in-scope product or service, firms should be looking for practices which might fall within any of the kind of the FCA red flag practices that they've highlighted in their papers. So any practices you have which might be viewed as exploiting behavioural bias should be dealt with. So that involves checking how you're presenting your information to your customers. If you've got low customer engagement or inertia, what can you do to engage them more? How can you encourage customers to switch to a better or cheaper product? Check also that none of your practices could be viewed as exploiting consumers' information asymmetries. Make sure you're signposting key information, that all information is available, it isn't tucked away, and that it's in plain English, so that consumers are empowered to make their own good decisions for themselves. Check also that you don't have any of the so-called sludge practices. So these are sort of friction practices that restrict customers from acting in their best interests. So what friction do you have when a customer wants to cancel a product, switch to another product, or amend their terms? Are you requiring customers to do anything more cumbersome when they're doing those things than they do normally when liaising with you? Make sure that all your information is readily available to your customers so that they can make their own informed decisions in their best interests. And if when you're carrying out that check of practices, you find you're having to change anything, bear in mind any potential changes you might need to make to your T's and C's as a result of the change to the underlying practice. So you'll need to review your terms and conditions too. Firms then also need to define what good customer outcomes are for their own firm, for their products and their services. So a way to do that is to really map the end-to-end product lifecycle and customer journey. That means looking at the product or service from product development, design and sign off, how it's marketed and originated to customers, what post-sale servicing looks like, through to closure of the account, redemption, settlement, etc. And on that timeline, it's identifying where your customer touchpoints are and what at each of those customer touchpoints a good customer outcome looks like. And when you're trying to define your good customer outcomes, bear in mind the consumer duty outcomes. For example, price and value. Does the product represent fair value? Now we know that fair value is about more than just price. It's about the benefits in the round of the product. For example, product features or enhanced customer support. It's not an easy assessment, and for many firms, it's going to be the first time that you're going to have to make that assessment. Think also about the consumer understanding outcome. Look at your communications across all delivery channels. So for some products, for example, mortgages and consumer credit products, there's already a certain amount of information that's prescribed that you have to provide to your customers. But the FCA has made clear that firms should be approaching communication in a much more broader way, and when they're thinking about delivering good outcomes to consumers. And sometimes achieving that balance is going to be tricky. And then also review your consumer support processes and make sure that customers are supported at each stage of the customer journey. Moving on then to monitoring and evidencing. Now, the consumer duty imposes monitoring obligations on firms. Firms have to assess customers' actual experiences and be able to show that they're delivering good customer outcomes. And management information is going to be key to evidencing that you are delivering on the consumer duty, that outcomes are being properly assessed and monitored. So firms should be reviewing their data and their management information that they are getting and checking that that is translating to good customer outcomes. So what sort of things does that involve looking at? A starting point is to look at what sort of monitoring you're doing currently. How often is it being carried out, and what data are you getting from it? How good is that data? Is that data evidence that you're generating good customer outcomes? What data are you not getting? What extra data do you need? Do you need technological solutions, or are some available that would enable you to fill those gaps and discharge your obligations? And finally, onto culture. And consumer duty needs to be embedded across a firm. You need to create a consumer duty. So in terms of governance, obviously the board has to have responsibility for consumer duty compliance, and there needs to be ownership at board level and also senior management level. But thinking on a more firm-wide basis, consider awareness raising and training around consumer duty. How are you going to engage your stakeholders so they all know what consumer duty obligations mean for your firm and your products and your services? Consider your training program rollouts, annual refreshers, induction training for new starts. And so that all areas of your business are taking a consistent approach to consumer duty issues, consider whether it might be beneficial to develop business standards that could be applied across the firm. Look also at your people policies to make sure that those are aligned with the consumer duty requirements, including incentives at all levels. And lastly, consider engaging with customers on consumer duty matters. Use outreach programs if you can to establish what those customers consider is important to them, because the better your understanding of what your customers are looking for, the better position you are in to discharge your obligations under the consumer duty. So there's a lot to be done, and there's not a huge amount of time to do it, is the message here.
Thanks, Lindsay. There's clearly a lot to be done. Can we expect to see the July 2023 deadline pushed back at all?
That's a hard one. I would say on balance, no. We've had a little bit of an extension already. That doesn't mean that all firms are going to make the deadline, and I think the FCA is aware of that. I would say that firms in pulling together their implementation plans and complying with their obligations, they should take a risk-based approach and focus on those reviews that will have the greatest impact for their customers. So look at your risky products first and look at your communications that will have that affect the most customers. And I think if you're doing that and you're putting full effort into the consumer duty, you're probably in the best position you can be to deal with the FCA if you are not able to make that deadline.
Thanks very much, Lindsay. So moving on now, I'm going to briefly look at the developments that have happened in relation to the Financial Services and Markets Bill, and then there's been a few updates in relation to regulation of cryptocurrencies. So starting with the Financial Services and Markets Bill, I'm going to briefly go through the timeline of the bill, a few of the key regulatory provisions, discuss the second reading that happened last week, and then look at what's going on next. So moving on to the next slide. So where are we now? So the bill is a bill to make provision about the regulation of financial services and markets and for connected purposes. So the bill was introduced back in July of this year, and a briefing paper was produced on the 1st of September. And last week, on the 7th of September, there was a second reading of the bill. And at the second reading, the key parts from a regulatory perspective were discussed. So Part 1, Chapter 1 of the bill allows for the Treasury to revoke or amend retained EU financial services law. And in Chapter 2, the bill grants additional powers to regulators in part to fill in the gaps in regulation left by the retained EU law being revoked. It will also allow for greater regulation of financial promotions and stablecoins. Chapter 3 of the bill will implement measures intended to ensure appropriate democratic accountability for regulators, considering the significant transfer of powers to them that the bill facilitates. This will include giving the FCA new secondary objectives to advance the international competitiveness and medium to long-term growth of the UK economy, and having regard to the government's commitment to reach net zero emissions by 2050. But as we saw in the debate last week, these provisions, in some people's view, don't go far enough. So the general consensus at the second reading last week was one for support for the bill. If we can just move on to the next slide there. However, there were two key points during the debate. The first being the concern over the lack of accountability of both the Treasury and the regulators and the new authority they would have if the bill isn't acted in its current form. An example of this is the current draft allows for ministers to call in and potentially overrule decisions made by the regulators. It was accepted at the debate that the key discussion that needs to be had on the bill is the accountability of the regulators. And it's confirmed that this will be a fundamental part of the debate throughout the progress, particularly at the committee stage. The next part that there was a general consensus on in the debate was a lack of emphasis on sustainability, green finance, and compliance with climate change obligations. Again, this will be taken to the committee. Ultimately, despite the cross-party support for the bill in general, unless these concerns are properly addressed at the next stage, the bill may not necessarily get to a third reading unopposed. Any amendments to the bill addressing these concerns, amongst others, will be available from the committee hopefully by the 25th of October this year, and it'll be interesting to see what has been taken into account from the debate. This is definitely one to watch, as there may be significant changes to the drafting of the bill. So moving on now to cryptocurrency, because as mentioned, the bill does deal with regulation of some forms of cryptocurrency. So I'm going to discuss what the current regulation is and then move on to what we can expect under the bill. So the current regulation of cryptocurrency in the UK, we know that there's not really any regulation in the UK at the moment. We have had guidance from HMRC in relation to tax treatment of cryptocurrency, and the FCA published warnings about risks back in 2017. But there is strong support for regulation of cryptocurrencies in the UK. As I'll go on to discuss, there's reporting now to the Office of Financial Sanctions Implementation. There's the Financial Services and Markets Bill. There are numerous consultations taking place at the moment in relation to this regulation. And there was a debate last week separately, specifically on the regulation of cryptocurrency in the UK. So one of the key developments that's happened recently is that as of the end of August this year, all UK cryptocurrency asset exchange providers and custodian wallet providers are now legally required to report to the Office of Financial Sanctions Implementation if they become aware or have reason to suspect either that a person is subject to financial sanctions or that a person has committed an offence under a sanctions regulation. There's not a huge amount of information from the government on this yet. What they have said is that when reporting about a customer, the crypto asset business will be required to include the nature, amount of any funds, whether it's cryptocurrency or other crypto assets that they held, and failure to report is an offence with fines or criminal prosecution, as well as the potential reputational damage. This requirement is significant as it's the start of further regulation that is anticipated in regards to crypto assets through the Financial Services and Markets Bill. So the bill is really what we're going to see next in terms of regulation in the UK for cryptocurrency. The bill sets out that the Treasury will be given new powers to introduce rules on the regulation of payments and service providers in relation to digital settlement assets, in other words, cryptocurrency. This will be the beginning of the UK's approach to safely adopting cryptocurrency as a suitable means of payment. Initially, the government will only be regulating stablecoins. So what are stablecoins? Well, most cryptocurrencies, such as Bitcoin, are characterized by extreme volatility and are not considered practical for use as a means of exchange. Stablecoins, on the other hand, seek to overcome this issue of volatility by being backed with reserves of currencies, so either dollars or sterling, or by using algorithms to control supply. So lenders and firms will need to be aware of this if and when it comes into force, as it is likely that the regulation will increase use of stablecoins. And although the bill only mentions stablecoins in the current drafting, there is possibility for broader assets of crypto assets, such as exchange tokens like Bitcoin, to be included in the regulation. So where does that leave us now in terms of regulation of cryptocurrency in the UK? Well, a huge part of the debate that happened last week on regulation was the fact that the government is always playing catch up in the fast-paced nature of this industry. So the regulation of cryptocurrency is very much in its early stages and is one to watch over the next few months, as it's high on the agenda for the new government, with consumer protection at the forefront of that regulation.
Thanks, Kiva. So we're now moving on to the next part, which is buy now, pay later. So buy now, pay later is a way to spread the cost of shopping, buying something today but paying for it over the following weeks or months. If a consumer opts for a short-term agreement of up to 2 months, buy now, pay later is usually free of interest or fees. The buy now, pay later firms make money by taking a commission from the retailer, which means that they don't pass any charges on to the consumers. Generally, lenders providing credit to individuals have to be authorised by and comply with the consumer credit rules of the FCA. Short-term interest-free credit, where loans are interest-free and have to be paid in 12 or fewer instalments within 12 months of the agreement, are exempt from regulation under Article 60 F2 of the Financial Services and Markets Act Regulated Activities Order. Interest-free buy now, pay later loans rely on this exemption. As a result, buy now, pay later sector is currently unregulated by the FCA. Currently, there is no requirement for buy now, pay later lenders to carry out credit checks on their borrowers, and many don't. This means that they may not appear on consumers' credit histories or affect their credit score. Without a full assessment of their ability to afford a loan, buy now, pay later borrowers could be at risk of taking on debts that they won't be able to pay on time. And a number of buy now, pay later lenders do charge late fees. Even though buy now, pay later is not regulated, the main companies in the market are large, respected firms that already are preparing for regulation. Buy now, pay later does not offer the same consumer protections as credit cards, being the other popular form of short-term credit. If a consumer makes a purchase of between £100 and £30,000 on a credit card, they will have what is known as a Section 75 protection. So this means that the credit card company is equally responsible with the company that they bought the product or service from if something goes wrong. A similar scheme also applies, known as chargeback, for debit card payments. So consumers may not be able to make a successful Section 75 or a chargeback claim if paying using buy now, pay later. As long as buy now, pay later is not regulated, it may also be that consumers are not able to escalate any complaints to the Financial Ombudsman Service. Some of the large buy now, pay later providers, such as Klarna, have voluntarily signed up to the Ombudsman's jurisdiction. But for those that haven't, it may be hard to get a complaint resolved independently without heading to the courts. So why is this relevant now? The exemption originally was not intended for this widespread type of use in the retail sector. It was originally intended for short-term invoice deferral, but it's also used by a range of non-financial firms offering interest-free credit, such as gyms for membership fees. The buy now, pay later sector has, however, developed at speed over the last few years, kind of benefiting from this exemption, including during the current cost of living crisis. The Woodlard report, which was published in February 2021, noted urgent need for reform in this sector. However, the regulatory position has not progressed during the intervening time. The Financial Initiatives Grid, which sets out the FCA's planned regulatory initiatives for the next 24 months, shows that secondary legislation to bring the current unregulated buy now, pay later products within the regulatory perimeter will not be laid until 2023, noting that the FCA will require to run a consultation on the proposed rules and then produce details of the regime after that. So unless these timescales are escalated, it is likely that the new regulatory framework for buy now, pay later products will not be enforced until 2024. So that is some 3 years after the Woodlard review called for urgent action. Despite not being able to regulate firms offering buy now, pay later products, the FCA has proactively used its powers to assess the fairness and transparency of the buy now, pay later product terms for 4 firms, being ClearPlay, Klarna, Laybuy, and OpenBuy, and has brought about changes to those terms, which made them fairer and easier for consumers to understand. There are existing fairness and transparency requirements which are contained in the Consumer Rights Act and the Unfair Terms and Consumer Contracts Regulations, although ultimately only a court can determine a term's fairness and/or transparency. The FCA has warned firms offering buy now, pay later products that although some agreements are regulated, are unregulated, the financial promotions of all buy now, pay later products must comply with the financial promotions rules under Section 3 of CONC and under FSMA. Unauthorised firms may be committing a criminal offence if they don't have an FCA authorised firm approve their products and promotions. Authorised firms selling unregulated or exempt buy now, pay later products must comply with the relevant rules unless an exemption applies. And this includes that buy now, pay later financial promotions must be clear, fair, and not misleading. The FCA is also continuing to engage with the buy now, pay later providers, calling on firms to support borrowers in financial difficulty, including signposting to money guidance and debt service advice. They are also proactively monitoring the market to ensure that expectations are met. The FCA again has confirmed it will use criminal and regulatory enforcement powers if it sees that promotions that do not apply or comply with these rules. So what can lenders and retailers expect? As part of the government's regulation of the industry, buy now, pay later lenders will need to be FCA approved to operate in the UK. The government expects that once the sector is regulated, buy now, pay later providers will need to carry out tougher affordability checks on its customers. So this is likely to be in the form of hard credit checks and will show up on customers' credit files. Consumers will also be able to complain to the Financial Ombudsman Service if they're unhappy with the way that Buy Now Pay Later firm has treated them. The intention is also for Buy Now Pay Later advertising to be brought within the full financial promotions regime, requiring Buy Now Pay Later lenders to give sufficient information about products and to be clear, fair and not misleading, in addition to the requirements under the Consumer Rights Act and the Unfair Terms in Consumer Contracts regulations. So quickly looking at retailers, retailers will need to be authorised for credit brokering under Article 36A1A of the Regulated Activities Order. One option is for those retailers who are not already authorised to become appointed representatives of the Buy Now Pay Later lender under the FCA's appointed representatives regime, meaning that it would be the Buy Now Pay Later lender who would have responsibility as principal for ensuring compliance with FCA rules. We're not covering the FCA's appointed representatives regime in this session, but if you would like to read more, please see our recent blog on our website. So on to the next slide. Buy Now Pay Later lenders and retailers alike should keep an eye on developments and consider how changes to the law could affect their business and procedures and contractual arrangements. And this neatly takes us on to the final topic of the session, which is the cost of living crisis, which I will try, looking at the time now, to very, very quickly canter through. So the cost of living crisis refers to the fall in real disposable incomes that the UK has experienced since late 2021, and it's being caused predominantly by the high inflation outstripping wage and benefit increases, and has been further exacerbated by recent tax increases. This slide has a kind of why is this happening? There's a number of contributing factors on the slide here that you can see. I would just pick out, well, a few: war in Ukraine, COVID, and then the linked economic resurgence. So as COVID has receded, the manufacturing and distribution sectors have kicked back into life, so triggering a further surge in demand for energy and more upward pressure on prices. We've got regulation in terms of a number of UK energy suppliers that have failed, weather, agriculture, etc. So on to the next slide. What costs have gone up, or maybe what costs have not gone up? Firstly, energy. There's been a rapid increase in energy costs, particularly in the wholesale price of gas. The government have announced a package of financial support measures, but the biggest worry for millions of UK households still remains the cost of their energy bills. Interest rate and cost of mortgages. So the Bank of England raised the interest rates in August from 1.25% to 1.75%, putting the bank rate at its highest level since 2008. So that's going to hit people immediately on variable rate mortgages, and those who are kind of sheltered at the moment with fixed rates will have a hike when they are due to remortgage, and also costs also apply to first-time buyers. The Bank of England have postponed a key decision on interest rates, saying that in light of the period of national mourning following the passing of the Queen, the Monetary Policy Committee's decision would now be announced at midday on the 22nd of September, with economists predicting that the UK Central Bank rates may rise to 2.25%. Consumer borrowings also up, including, as discussed, Buy Now Pay Later and other forms of credit. So what are the FCA expecting of lenders? Supporting customers struggling with personal debt or showing signs of financial difficulty, helping them to obtain the advice that they need and avoid falling victim to scams or illegal money lending, and tailoring forbearance to individual circumstances. Lenders will also need to consider whether there is anything that they can do to encourage borrowers to think about switching to less costly products. Effective early engagement seems to be key. Key communication with customers, ensuring that they are aware of where they can get help and also the risks on taking on different types of debt and credit. The FCA also expect firms to train their staff so that they are able to identify and work with borrowers with vulnerable characteristics and ensure good outcomes for their customers. Firms also need to be operationally resilient and test operations to ensure that processes, systems and controls are adequate to withstand any increase in distressed borrowers or defaults, operational failures or fraud. For those customers who aren't struggling, information should be available on how to reduce outgoings, such as switching to products which may be giving them a better deal. No one knows how long or how deep the cost of living crisis will be, but the FCA have noted that firms should hope for the best, but plan for the worst. So the looming question here is, in the financial services sector, whether the cost of living crisis should be tackled in a similar manner to the pandemic, and where early intervention, flexibility and forbearance were implemented. All we can say is, I think, watch this space. So I'll now pass back over to Lindsay.
Thank you, Kimberley. So clearly a lot of regulatory change, and this is very much just the tip of the iceberg. We knew we were going to be pressed for time. We wanted to bring you as much as possible, so we have been squeezed on the Q&A section. But as Kimberley said, if you have any questions on any of the matters we've discussed today, please either pop them in the Q&A function just now, or send us an email direct and we will come back to you. Finally, please do complete the very short survey that you'll be getting. It will help us bring you seminars on and other training on topics that are important to you. And all that remains for me to say now is thank you very much for joining us. Apologies for the slight overrun. We hope you found the discussion interesting and that you will join us again at our next Banking and Finance Academy. Thank you.